Welcome to this explainer. Today we're diving headfirst into what is gearing up to be the largest initial public offering in human history, the SpaceX IPO. But as we start peeling back the layers of SpaceX's massive valuation, we're going to reveal something much bigger, and frankly, much more concerning. We are looking at how the underlying financial plumbing of the stock market is quietly shifting right under your feet. Let's get right into it.
Okay, let's talk about this staggering target valuation, $1.75 trillion. To put that completely astronomical number into perspective, at that price tag, SpaceX would be worth more than every single American defense contractor combined. But wait, it doesn't stop there. Add up the market caps of Disney, McDonald's, Nike, and Starbucks, put them all together, and SpaceX is still supposedly worth more. It's a monumental figure, and it absolutely demands some serious scrutiny.
But here is where the illusion begins to crack, and where we find our central mystery. When you look at the consolidated company, SpaceX is actually burning through $5 billion a year. So the trillion-dollar question becomes, who exactly is financing this unprecedented IPO valuation for a company operating at such a staggering loss? Well, to figure out who is buying, we first need to shatter the public illusion of SpaceX and look at its actual corporate anatomy.
Part 1. 3 businesses in 1. If you ask most people on the street what SpaceX does, they'll just say it's a rocket company. But the reality is very different. SpaceX isn't just a rocket company. It's actually a stack of 3 completely different businesses, all with vastly different financial realities. When we look at the 2025 revenue split, we've got Starlink making up 61%, rockets sitting at 25%, and xAI alongside some other ventures making up the remaining 14%. Basically, there is the good, the bad, and the very ugly hiding inside this structure.
Let's start with the part you already know, the rocket business. This is the division launching satellites, sending cargo to the ISS, and running crewed missions for NASA. Now, it generated roughly $4 billion in revenue last year. That sounds really impressive, right? But remember, we're talking about a $1.75 trillion target valuation here. The rocket business only brings in about a quarter of the total revenue, which honestly hardly justifies that massive price tag. So if the rockets aren't justifying the valuation, what is?
Part 2. The crown jewel, Starlink.
Think of this division as basically Comcast in space. Starlink is an absolute technological marvel. It's actually the fastest scaling telecom company in human history. They've launched over 10,000 satellites into Earth's orbit, beaming internet down to little dishes on roofs all over the globe. They now boast over 10 million active subscribers across roughly 150 countries. It's a wildly powerful product.
And underneath that massive revenue is some truly breathtaking efficiency. In 2025, Starlink alone brought in $11.4 billion. But the profit margins are the real story here. 2 years ago, Starlink's margins were at 41%. This year, they have skyrocketed to 63%. Margins have exploded by over 20 points in just 2 short years. Starlink is practically printing cash right now, expanding into maritime and aviation markets and locking down classified defense contracts. An absolute powerhouse. But if Starlink is wildly efficient and the rocket business is doing just fine, where is all the money going? Why did we mention a massive $5 billion loss just a minute ago?
Which brings us to Part 3, the xAI money pit.
Enter xAI. A few months ago, SpaceX acquired Elon Musk's AI startup, xAI, in a $250 billion all-stock deal. To really grasp how wild that is, we have to compare it to OpenAI. OpenAI generates about $24 billion in revenue and is valued around $850 billion. Meanwhile, xAI estimates just $1 billion in revenue, but was bought for $250 billion. So the market is pricing xAI like the premium Emirates airline, but its financials look a whole lot more like budget Spirit Airlines.
The really crucial point here is that SpaceX absorbed an AI lab that is in serious trouble. By March of this year, every single one of xAI's 11 brilliant co-founders had walked out of the company. It's literally lighting $1 billion a month on fire. And to top it all off, it was publicly admitted that xAI needs to be rebuilt from the foundations up. So SpaceX essentially paid $250 billion for an asset that needs to be completely rebuilt from scratch.
And boom, that is exactly how we arrive at this number. Thanks to xAI acting as a massive anchor, dragging down the balance sheet and burning whatever cash Starlink and the rockets happen to generate, the consolidated SpaceX entity lost nearly $5 billion last year. And that's despite bringing in roughly $18.5 billion in total revenue. Which brings us right back to our massive mystery. How does a deeply unprofitable, cash-burning company guarantee the biggest IPO in history?
Part 4. Changing the NASDAQ rules.
The answer lies in the financial plumbing of the stock market, specifically the NASDAQ rules. On May 1st, NASDAQ quietly adopted what's called the fast entry rule. Under the old rules, a newly listed company had to wait 3 months before being added to the NASDAQ 100 index. This gave the market time to discover its actual price. But this new rule, it compresses that waiting period down from 3 long months to just 15 trading days. It completely erases standard price discovery and fast-tracks the stock directly into the index.
Next up, they removed the free float requirement. Previously, to join the NASDAQ 100, a company needed a minimum of 10% of its shares as a free float, meaning shares that are actually available for the public to buy and sell. Well, NASDAQ scrapped that rule entirely. And this is incredibly convenient because SpaceX is reportedly targeting a tiny free float of just 4 to 5%. Under the old rules, they would have been automatically disqualified. Under the new rules, the red carpet is rolled right out for them.
But wait, it actually gets crazier. Finally, buried deep in all this technical jargon is a hidden multiplier. For companies with a free float under 20%, NASDAQ now legally forces ETFs to treat the float as if it were 3 times larger than it actually is. This means SpaceX's tiny 4 or 5% float gets weighted as if it were 12 to 15%. They are literally manufacturing massive artificial demand. And all of these engineered rule changes bring us to the final piece of the puzzle, your wallet.
Part 5. You are exit liquidity.
Just look at this allocation comparison. While traditional IPOs usually allocate around 5 to 10% of their shares to everyday retail investors, the CFO of SpaceX admitted to bankers that they are targeting a massive 30% dump right onto retail buyers. Why? Because they know retail buyers have been incredibly supportive and loyal to the brand. They are banking entirely on blind loyalty over actual financial fundamentals.
The buyers and sellers just aren't showing up at the same time here. Portfolio manager George Noble really hit the nail on the head with this quote. Your 401k is the exit liquidity. What this means is that early insiders who are sitting on shares with a super low-cost basis can cash out at these massive artificially engineered valuations. And who exactly is left holding the bag? The mechanical forced buying power of passive index funds and everyday retail retirement accounts.
So, as we wrap up this explainer, I really want you to consider the pitch we've all been sold on passive investing. It's low fee, it's diversified, it's the ultimate set it and forget it strategy, right? But the very feature that makes passive investing so convenient also makes you a guaranteed buyer for whatever squeezes its way into the index, regardless of the company's actual financial health. I want you to take a hard look at your investments and ask yourself, what else is quietly being added to your portfolio without your permission? Thank you for watching, and keep asking the hard questions.